Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today's Thursday. Happy Thursday, everyone. And it is December 20th, day after the Fed announcement. We'll touch base on that here in just a moment. But first, we'll start off with the economic calendar. We have this week's weekly jobless claims, and well, actually, these reporting for last week. So the previous week came in at 206,000, which was a good sight because we were going rising upwards, and we were and having that reduction down to 206 was a good number there. Forecast is supposed to go up to 218. It did go up, but not quite as high as expectations at 214,000, which is also a very good number. So if you look at the 4-week average, that basically brought us into 222,000 people applying for unemployment on a weekly basis. So that's a pretty good number. And also the more important thing for this week's number at 214 and why it's a low number is that this is going to be used for the jobs numbers come for December. So when we get January 4th, when the uh, BLS, Bureau of Labor Statistics, release their job numbers for December. This is part of the formula that they use with the unemployment rate. This will be the data that they use. So they use this as their sample week in those terms there. And that could help show another strong jobs number for the month of December here. To move along here, we got the Philly Fed. This is the manufacturing region, the Philadelphia region. We were at 12.9 in the month of November. Forecast had it rising to 14 in December. Instead, it dropped down to 9.4. So obviously, things have slowed up a little bit in manufacturing-wise in the Philly area. Last but not least, we got the leading economic indicators. This is important primarily because it does give us a little insight into projections into the economy where it's moving towards, and usually it kind of looks towards 6 months down the line. In October, it didn't look as promising when it dropped 0.3%, but in November it rose 0.2%. So this is going to be interesting to continue going forward to see how this, if this continues rising or if this is going to go down. Because right now, obviously, investors are concerned about a global level where China and Europe are showing signs of slowing down. We got the Fed raising rates, which will typically slow economy down domestically, and right now the U.S. still seems a little strong here, but at some point it's going to take its toll and slow the economy down here, especially after yesterday's rate hike, which will put us into a negative yield curve. And past usually indicates that a negative yield curve after 1 or 2 years, you kind of it leads into a recession. So let's kind of take a look here. Stock market is down. It's kind of the after effects of the Fed announcement yesterday. Dow is down about 100 so far. Stock market was up until they had the FOMC announcement, and then as soon as that came in and came in a bit more hawkish than they really wanted, it really sold off quite a bit. And on the beneficiary side, the mortgage-backed securities went up, and that helped us out and show a little bit of improvement in the interest rates. So, what about the Fed? What did they do yesterday? Well, we expected a 1/4% rate hike. Some people are kind of hoping that they might not, but they did raise the hike. They did hike at 1/4%. That gives us 4 for the year, and then but here's the couple other items here that really kind of the investors did not like. Forecast for 2019 in September's meeting, they showed a 3 rate hike, but they reduced it to 2 possible rate hikes in 2019. The investors want to see obviously 0 more rate hikes because they feel that the Fed is being overly aggressive, overly hawkish in this terms in their rate hike decisions, and especially when you're looking at the global or the macroeconomics of where things are at, and inflation is still in check, that they feel that the Fed is being a little overly aggressive. Another item to pass note on is the quantitative tightening. Now, this is something you can probably start hearing a little bit more on the news, as this is something that's in February. The Fed they announced this a while back, but they've been increasing that going forward. Is basically they stop purchasing mortgage-backed securities and government debt. They are basically what they're doing is reducing their balance sheet. After quantitative easing to stimulate the economy, they've accumulated a pretty large balance sheet. Now they're trying to unwind that balance sheet by tightening it up Typically, when these get reissued, they'll reinvest that. But as of right now, they're putting in this on as Chairman Powell said yesterday, it's on autopilot. So right now, $50 billion every month is being reduced from that balance sheet. Now, what happens to this? The market kind of has to absorb it, and that's probably going to lead to higher rates down the line here because there may not be as much appetite. Now, the stock market down is kind of helping a little bit, but it's not going to be down, forever. And at some point, this is going to come to fruition where it's going to increase our long-term interest rates, and that could be more detrimental to the economy than the Fed raising hikes. So this will be something we have to kind of keep an eye on, see how this is going to play out. But again, that's something that you'll hear more about with the headline news and everything else as they continue with these decisions. Something else going forward in 2019, be aware of. Typically, after a meeting, the Fed usually only hiked rates on a quarterly basis, primarily due to the press coverage. If they did it prior to that, when there was no press coverage, it was primarily due to an emergency, and that's the last thing they want to do is surprise the markets on an emergency basis. So they always kind of saved the rate hikes on a quarterly basis when there's a press coverage after their meetings. Now in 2019, there will be press coverage after every meeting, so this could happen anytime in 2019. Most likely, the earliest we may see a rate hike in 2019, maybe March. It'll give them some time to see some of the data going forward where things are at before they decide if they're going to hike or not. So most likely we won't see one until March anyways if we do see another rate hike. So let's go ahead and see how the bonds are going so far this morning. We are still about this 200-day moving average. We tested yesterday with this big wide trading range. As you saw, we were way down like 22, 27 basis points, came up, and we actually were up for the day. We closed up 13 basis points. We're even up higher, as you see with this wick here. Today we started off lower, but right now we're currently up about 2-3 basis points. But this has been kind of ranging down 2-3 basis points and then up 2-3 basis points. So it's kind of this little bit of a range here, kind of going in a sideways pattern. It's going to be pretty volatile today. So be cautious out there if you're out there with a refinance or any refinance or purchase transaction to have a quick finger on the trigger because we don't know how long this could last. But this should be a strong floor of support, which is the good news. On the other hand, here's the yields. Yields broke down below that. We had another layer up here around 2 up here, broke down. We're testing this 2.76 range on the yields. If it breaks below that, we got a little bit further room down, which could help out mortgage-backed securities. But as of right now, it's kind of holding at 2.76 on the yields. We'll have to kind of wait and see how it again plays out. So right now, I advise go ahead and float for the time being, but have that finger on the quick lock button. You guys have a great rest of your day. If there's anything changes, I'll post on Twitter. You can find me at Mike Bjork. Otherwise, enjoy your day, and we'll look forward to see you guys tomorrow. Bye-bye.